There is a substantial risk of loss associated with trading forex, binary options, stocks, or equities, collectively, asset classes. Only risk capital should be used for trading. Trading in any asset classes is not appropriate for everyone. Past performance is not necessarily indicative of future results. No representation is being made that investors will make profits, or will not sustain losses. Before trading in any asset classes, investors should consult with their professional broker, financial advisor, or financial consultant to determine whether trading asset classes is appropriate. Investors who trade in any asset classes should only do so if the capital used for this purpose represents funds that an investor can afford to lose without adversely impacting the investor's lifestyle. No trading strategy or methodology is without risk of loss. No trading strategy is risk-free, and no trading strategy can guarantee profits or freedom from losses. Investors risk losing the cost to execute any transaction, including associated commissions or fees. You should carefully consider whether trading in any asset class is appropriate for you in light of your investment experience and financial resources. Any trading decisions you make are solely your responsibility and at your own risk. None of the statements or materials in the Auvoria Prime chat rooms constitute a solicitation or recommendation to buy or sell.
Let's get back to our regularly scheduled programming. Welcome again to the Tuesday, sometimes Wednesday, midweek software strategy session. My name is Steve Vetterl. I am the firm's chief market analyst. But I just looked at myself essentially in the mirror and said, hey, you're the risk guy. Talk about stuff. Try to do these broadcasts right after, in this case, 2 p.m. But I try to do as close to 1 p.m. on Tuesday as possible. The Saturday call is a little bit after 10 a.m. Eastern Time. We're coming to you live on the microphone from here in Orlando, home of one of the best run state governments that runs a surplus. We love it. Hats off to all the politicians, and that is not something that I normally say. So, we will put one's opinions and soapbox aside and focus on the matter at hand. The matter at hand is that regardless of what I talk about, right, almost everything I show can be applied to the trading of almost any market out there. So if you're a commodities trader or forex, trade equities, care if you trade classic cars, I mean, there's patterns and stuff that you can look for in anything, right? And you want to look to see whether those patterns have depth, if they have breadth, right? Unlike the Eagles team last night, who probably walked into the game thinking, hey, we got the Washington Redskins all wrapped up. And yes, in the Vetterl house, it is the Washington Redskins. We have this team all wrapped up. But like those that choose to live in the fifth dimension, which is basically where the Eagles were last night, or you have not properly assessed your opponent's strength, something we also suffered from last night, you will get trampled on or beaten, right? Steve, why does this matter in the markets? Well, it matters because very simply, if you can assess risk by looking at all factors, right? And by all factors, I mean not what some guru is looking to tell you in a trade room, right? You know, I can tell you that there is no 7 or 8 figure traders on this planet, and I know a few that have actually made it to 8 figures, and yes, they are real, that got that because they spent time in a trade room following the trades of somebody else. Right? They essentially were learned to fish on their own. You may have had a mentor, which I think is a great idea, especially the ones that can help you cut through, a good 2/3 of the learning curve. But a lot of these ladies and gentlemen that I know, they spent all this time doing this themselves after, whatever type of tutelage they went through. So, in the case of myself, I was fortunate to have really absolutely hit it off with a big Goldman Sachs trader way back in the days, this is early 2000s. And him and I were huge fans of motorsport at the time. And, we got it, and he basically taught me how to trade. And, I've been watching a lot and traded a fair amount myself on desks at Fidelity in the early days. Figured I needed some sort of mentor. And he taught me market profile, taught me auction market theory and everything I needed to know about technical analysis. He is now retired. We talk a lot. He is wealthy far beyond his or his children's dreams, but he still makes everybody work for it. Everything the guy approaches in life is based upon risk. I don't care if he's buying a rake at Home Depot, right? He's assessed risk in that purchase. It's funny, whether it's don't get down there in a rainstorm and, risk having a tree fall on your car, right? That's an assessment of risk. So in everyday life, I think that I probably seem a bit extreme about how I take on every decision I make. And no, we're not weighing options that much when it comes to buying a candy bar at the store. But in my case, where I probably shouldn't be eating the candy bar, I'm assessing the risk of eating it, right? Whether it be a heart attack or maybe I should just be in the gym on a treadmill, right? We'll be out in the woods of the flat terrain of Florida riding my new mountain bike, which is getting some use, but it's also collecting some dust. In any case, I reflect upon that because I just want everybody to think before you act. Why am I saying this? All of the interviews, which still to this day just continues to shock me, all of the interviews that I have seen this weekend, and it wasn't a lot, but I think I have a decent enough data set of everybody that invested in FTX, didn't really do their due diligence. How can you be XYZ Teachers Pension Fund and not have really done a deep due diligence dive before you handed FTX in excess of several $100 million? Think about that, right? It's laziness. So if they had dug into the fact that there was all kinds of counterparties out there that were concerned of FTX's trade practices, and it's funny how that all sort of emerges much more in a brighter light after this fact, right? Can I speak from an authoritative comment on this? Yes, I can, because unlike a lot of my trader buddies at the time who had accounts at MF Global, there was only one reason I never had an account at MF Global. They were a futures commission merchant, was run by John Corzine, who I find to be an abhorrent individual. And because of that simple fact that I might hate, if you will, yes, it was hate. There's a lot of bad things John Corzine did. If you're ever bored, you can Google him. It's an ex-Goldman partner. It's part of one of those skull and crossbones bastards. I wouldn't have an account at MF Global. The funny thing about that is MF Global blew up, and a lot of people lost all their funds. Now, in all fairness to the story, they did get some of their funds back, but it took 5 or 6 years. And in many cases, those people who completely written off their investment and or jumped off a bridge in a couple cases, right? So why, of the 6 or 7 interviews, and I was involved in a couple of chat rooms with, hell man, that guy CZ Binance actually popped in the room. I was shocked. He's one of the richest guys on the planet in crypto. He owns the Binance exchange. And, he basically, he said there was all kinds of counterparty risk, right? So that's like Jeff Bezos jumping into a forum I was lucky enough to be part of on Sunday. It was actually really, really extremely informative. One of the most informative chats I've ever been in my entire life. And I learned a ton about crypto. But the thing I learned that was just absolutely amazing to me is that there was concern among all of the other counterparties as to what was going on. So a simple call, right? What's called a channel check. So in the old days of retail analyst Steve, I was tasked, and in the particular category I was in, of doing what's called channel checks. And that's where you basically check on, your retailers. How are they doing? How are they compared to? How's Target doing versus Walmart? Versus Kohl's and all the big retailers at the time. Sears is more prevalent back then. And I did a lot of channel checks, and it's almost like everybody that invested in FTX, they didn't do any channel checks. I mean, how hard, if you have that kind of dough, would it have been to call up somebody at another crypto exchange and say, hey, what are your thoughts of these FTX guys? You guys like happy trading with them and stuff like that? And, a lot of them will just be like, well, yeah, but just, a few things just seem off, right? That's what a whole bunch of these guys said. So the guys at Kraken said that. They're another big crypto exchange. And they're funding all that crazy stuff I've learned about crypto this weekend. But it's just absolutely amazing to me. I mean, whoever writes the best story on this, and it is, maybe it's Michael from The Big Short, and I don't know. Whoever writes the first story, I think this is going to be a fantastic movie. I really do. But it's probably going to take a full year for this onion to completely be peeled open. And we are going to find that most individuals out there haven't done their due diligence, right? So a lot of people always ask me, well, what's your due diligence, right? So it's nothing more than like if you buy a used car, right? I just bought my wife an Audi Q7, I don't believe in buying new. So I like to buy used, typically 2 or 3 years, to let someone else take the hit, right? But before I buy the car, we run a full Carfax on it, right? I'll actually Google the VIN number, and I'll go out and look to see, what's up. Nothing shows up on VIN search, and everything on the Carfax is good, great. Then I'll look at the vehicle history, right? They change the oil every 5 to 15,000 miles, depending on the type of oil. Has the car been any dents? Has it been repainted, right? Has it changed owners 6 times, right? Red flag, right? I mean, it's all like not difficult stuff in my opinion. It really isn't. I mean, and then the sad thing about this is guess who suffers? The teachers that are going to draw money on this pension. Why? Because a couple of knuckleheads didn't do their job and didn't do a deep dive research, channel check, whatever the hell you want to call it, before they invested several $100 million with FTX. I mean, it's just, I'm beating a dead horse on this subject, I really am, but this absolutely amazes me, right? So, in the old days, we had to do such deep research, it was bananas. I mean, it was like overkill. But we rarely got it wrong, right? We didn't get our forecasts 100% right, but we at least knew what pile of data we were dealing with based on the work we've done. So, all I'm going to say is, you don't have to spend 10 years before you buy something big, right? I get accused by many in my family, mother and father-in-law, all kinds, I just do a pretty deep dive before I buy something, I did probably 2 or 3 hours of research on a gun I just bought. And it just, you find stuff, in many cases, it talks you out of the purchase, right? I've talked myself out of probably about 5 or 6 car purchases in the last year. Mostly because I uncovered shady stuff, right? And slimy ass owners trying to pin off all kinds of shady crap on me. I just wouldn't go for it. So I'll just say in the future, if you're buying a house, get the place inspected. For God's sakes, don't waive the right to an inspection. It's just foolish in my opinion. What if the house is sitting on the Krakatoa, right? And there's a volcano about to blow up through the bottom of the house. I mean, there's all kinds of, you can have some comedy in this discussion, but, get the house inspected. Take a look at the place yourself. Go bang on all the neighbors' doors like I did, right? Kids thought I was crazy. Found out a couple of neighbors in this one neighborhood, they're pretty shady people. This was back when we were purchasing in California. And then we found out the 2-3 streets over is a meth lab. Really expensive house, right? So needless to say, you do enough digging, there's all kinds of stuff you can find, right? You can Google people, and when you Google this, what was the joke that they called this guy the other day? His nickname was Scam, Bank Fraud, Deep Fried. I guess that's the guy's new nickname on Twitter, which is pretty funny. But I mean, if you just done a deeper dive and or gone to visit this guy's operations in the Bahamas, you would have seen it looks like Pigpen's house with a bunch of computer screens everywhere. Okay, maybe he's a genius and he's figured something out and he's not clean. Maybe not. But to me, that'd be a red flag, right? So, I don't know. I just... it's exacerbating, I gotta tell you. And then I gotta answer a whole bunch of questions on this stuff, and people think it's, things get linked to this and that. I don't find any link between the crypto markets. If this was really that bad of a deal, we probably would have seen more ripples. Who knows, we may, right? With usually events like this, the concern is, this is an unregulated industry, but if this had been a large brokerage firm that would have gone poop, What would have happened is the U.S. Treasury would have long been in touch with all their counterparties, right? So if Fidelity's going under, they'd be calling Schwab and making sure the trades are settled okay, and Goldman and JP and all the big brokers in this country like Morgan and UBS and God help us, Merrill Lynch. The risk really through ripples is just it's counterparty risk, right? So it almost blew us up in the 2008 financial crisis. So, the moral of the story here is, you don't have to spend hours and do ridiculous deep dives on the simplest stuff like I do, but I can promise you, you're going to be better prepared. So let's talk about the news here I have up on the screen. Our reason for all the goofiness to be going on in equities, and that is a slightly less, remember this is just month over month, producer price index. See that? So 0.2 actual forecast, double. Came in lower, markets rallied, although I think they probably had already rallied in front of this in the anticipation of this. But the interesting thing is that Fed Governor Christopher Wallen warned on Sunday that the central bank essentially is a ways to go before rate hikes, right? He basically scolded stock market investors, telling them that last week's weaker than expected CPI report was just one data point, which is true, right? Everybody's trying as hard to put the two. And I don't know this is necessarily a risk. I guess if you're short, this is. But the fact that people just want to race back into equities is a great example of lack of understanding, right? This is probably going to roll over and they're going to get bombed out, especially if they've gone heavy, long, levered, right? Everybody's trying to pick the bottom. And, I just think that, he agreed on, that the Fed may slow the pace of rate hikes to maybe 50 basis points at the December meeting, but, he insisted it would not constitute a change in fiscal policy. He also warned that the Fed interest rates will keep rising. It may stay high until inflation drops to near the Fed's 2% target. That's a long way from 8%, right? I don't know how fast they can get it to come down. That's the problem. I get asked that question a lot. I try to address it. The problem is that something taking hold, right? So just look at yourself as like, plant some seeds, and maybe 3 to 10% of the seeds make and everything else dies, right? You just don't know what's going to hold and what's going to take. So if all of these Fed increases just completely shut down financing, and we see it already here, just because of the fact that we're an independent money manager, we're not a broker, but we're a financial advisory firm, what they call an RIA. We deal with a lot of brokers out there, primarily Schwab, but we're already seeing in the premium finance space, which is basically borrowing money, or at least a partial borrowing of money to pay for a large insurance policy to protect a company or key executives, and it's what's called a large life or advanced markets case. Many of those premium finance policies in the old days, you could get them for like 2.75, 2.8. They're closer to 5% now. So it's basically doubled. So effectively, what does that mean? Well, you're looking to pay for a large life insurance policy's premium with somebody else's money, you're going to have to get over 5% return for the arbitrage to pay off, right? And, many of these long-term policies, can do that because costs of insurance have gone way down in the life biz, so you can do that with these big policies. But an 8 or 9% return inside these policies, while it is doable, you still got almost a 5% cost of capital to potentially get a return of 8 or 9%. Doesn't mean it's guaranteed, right? So in a year when there's no return, it's a zero return inside the life policy because maybe the market's down or flat, right? You don't lose any money, this kind of stuff. But it's still costing you 5% to borrow the money, right? So use that hopefully oversimplified example and everything else in life from the standpoint of a commercial producer, right? Think about the guys in real estate that have all these levered up portfolios. I don't care if it's a private equity, real estate, an LP, a REIT, whatever the organization or the amalgamation of real estate portfolio looks like, the simple fact is, in some of these cases, they've borrowed 2 and 3 times the lever of the portfolio. So they may only have $60 million in equity in the fund, but he's got $350 million in investments, right? So, what happens if, prices start coming down, everybody starts calling in the paper? It's going to get ugly. It's going to be just like 2008. So I think this is what the Fed, and personally, I just think that they flat out overlooked this, right? That's why I wrote this blog. I don't know if you guys saw this, but since, let me just show this to you guys. I think it has a strange title, but the point is important here. Go to our home page. This is for my investment firm. But I'll go to the blog, and even though the picture's kind of creepy, which I thought was funny, this is exactly what the Fed did wrong. So, the title of this blog is A Walk Down a Dangerous Fed-Induced Memory Lane. And it just goes through all the pitfalls that I've been talking about for 3 weeks. I tried to write this quite simplified so it wouldn't fly everybody's head, but the core understanding here is that if things just cost a lot more to borrow, and there's no more essentially free money, which is pretty much what it was, what's going to happen? Capital improvements are going to fall precipitously, right? We have one client that owns, I don't know, probably one of the larger mid-sized steel structure building companies in the Midwest. Lives, or I should say, in the mid part of Tennessee. He does projects all over the place. He's already had his projected projects that he was approved to go for, but cut in half for the 2023 year. Essentially, half his projects got cut in half, right? And some are just tabled. Hey, we'll get back to you. We don't have the financing lined up. So if that continues to just, and I've given 3 or 4 examples over the last couple of weeks, if you just sort of think about how that could permeate itself through the entire economy, I think the problem I'm not even sure I understand the speed at which this can work, but in the old days, which my kids get sick of hearing, when I worked for Ken Fisher, we were a fairly small, nimble money manager, and we often would compare ourselves to like a Donzi, which is a very nimble Italian speedboat. They make all kinds of other boats now, but they were just exceptionally well, like Chris Craft would be, in navigating, rough waters. But essentially the firm's turned into an ocean freighter that doesn't have any more nimbleness, right? With 160 billion under management, they can't just go out and sell a whole stock portfolio in one day, right? It would completely move the prices of, the 60 or 70 equities they typically have in a portfolio. And, it's just absolutely, it becomes a self-fulfilling prophecy, right? The Fed can raise rates and then the whole economy hits the brakes, but it isn't like that little Donzi. It's basically like turning an ocean freighter around. And then by the time the thing gets turned around, everything's okay in inflation land, and then they start lowering rates, and what happens? The thing's still headed and running aground, right? Like that one that got caught in the Suez Canal, which I find amazing. It took them forever to dig it out. But that's, I think, a great analogy to how long it can take, to get some of these huge economies across the world to back in action. So, if you're wondering why I think this way, I think this is a good blog that sort of illustrates that. But let me just make the screen bigger, take a closer look. So later this week, we've got Philly Fed manufacturing. And I think this isn't really going to apply much. And I'll go over Saturday on next week's stuff, because keep in mind the calendar gets lighter and lighter as we move closer to the holidays. So just looking at the actual calendar here. So we've got Thanksgiving next Thursday here in the U.S., right? It's always the last Thursday of the month, right? So we basically have 6 full weeks after this week. 6 full weeks, actually no, including this week, think about that, Monday, Tuesday replaced the first and second. We basically have 6 full weeks before the end of the year. Trading volumes will be a little bit lighter, but I think that at the same time it's important to understand that even if the junior folks are manning the desks, it doesn't mean there can't be wild moves and stuff, right? Now I went through a lot of charts this weekend, which I'm really not going to go through. I'll just take a quick peek at some of the main ones going on so you can see kind of what's showing up here. And I'm supposed to need to do some sort of data refresh here. Something just does not look right with this data. Like why? Right, whatever. So let's just take a quick look at the DXY. I mean, I think this thing has rallied back a whole bunch because of the simple fact that even though the DXY was stuck in a range bound, 108 was actually the low part of the range. You know, we broke below that, and a lot of that has to do with the direct correlation between that and a rally in equities over that period of time. So, the problem with this lower range that we're in is it's pretty big. You know, essentially we didn't really bust into this range to any large degree until probably the beginning of September. We're now in this upper range, and we just sliced through the bottom, and that really has almost everything to do with this. The marketplace, at least a chunk of the marketplace, believes that the Fed is going to pivot. I don't believe it. If in fact I am right, remember I can always be wrong, and the cooler heads prevail, or we get a better view underneath the hood, if you will, we're going to be right back up inside this zone. I wouldn't be surprised to see us trade back inside it after this overreaction break to the downside, which corresponds to all the lifting in the broader markets, at least in terms of developed markets and equities. So here is the euro. Exact same thing. I continue on the same theme with on Saturday. I'd expect it to get back down inside this range. You know, I think if you want to sort of get a heads up on things, is to take a bigger look at some of the rate changes or the changes in inflation rates for some of the other countries out there, which you can just peel through Forex Factory and see what's going on the next couple of weeks and get an idea of where things are headed into the end of November if you want to do a little prognosticating. But I think ideally I would be best just trading inside the ranges that I gave on Saturday, which is defined essentially by just under the 97.50 area here, all the way to the one spot 0.021, somewhere inside that area. You can even lift it up previously to the area it's stalling out in currently. And notice that 200-day moving was pretty powerful. It came right up against it. This is one of the few times, by the way, if you're all this other stuff is sort of the prevailing current, it's one of the few times I actually will step in front of the train on something like this, because this is an extreme out move. And we went up and just boom, right through, and was totally rejected. Now there could be a lot of other factors up here, right? That's usually why these first stabs into these, you know, like crazy move areas are always the best trades to take from, and the only ones that I will take that are what I call an extreme out. So if you're not got 100% familiar with what I'm talking about, it can apply to anything. It just happens to show itself right here on a daily chart of the euro US dollar. But see how we came up against this? This is a big area. Not only the previous low, right? See this zone right here, but there's a whole bunch of other confluence in here. I wouldn't be surprised. I don't have it dialed in, but there's some sort of big fib that was hit here as well from a retrace standpoint. But you know, the for that matter, probably a bunch of downtrend lines that came from. In any case, those first shots into areas like this, provided you're not trading with capital you need, those are always fun ones because they can really play out. All right, I've got as high on spot 048. It's already dropped. I mean, that's a good trade right there. She's hundreds of pips. I love it. All right. Let's take a quick look at crypto and I'm going to be done. I think we've cooled out here. Obviously this red line can be adjusted as we see fit. But if you want to include the red line, include all of the high the high of dares, that's funny. The hold on for dear lifers, the high of dares. 20,000 is the center point of all trading. That's this red line right here. It's called the point of control. It's where all the volume is executed over this whole period of time. It's basically look at the entire 2022 area. You can even drop it to a weekly if you want to analyze everything that has been since the run, which was October. We just want to see just the run. See that? So the entire run, all the last 2 years, point of control is right under 20,000, 18.3-ish area. That's why it's held so long. See that? It'd probably be easier if I show you full screen. Let's set this up right. There we go. So we're just looking at the aggregated execution. It's not a weekly chart, by the way. By the way, I just noticed there's a total notch missing in this profile here, you guys. Look at this. So right at the 25,628, if you guys want to make a note of this, I mean, there's definitely, that's what's called a valley or a missing notch, meaning there's an incomplete auction up there. So a lot of times markets like to go get that stuff. Can't say that's the case for crypto because I don't know about how aggregated volume operates, but in normal markets, let's see if I can bring this in better focus. We really only care about the volume that's taken place since the run up. And then there's that. So this point of control is registering right around 19,000. See how it held trade for a long time? It was also like a floor it was trading on. And then we just absolutely sliced through it. So when that takes place, typically, can't say crypto is a typical thing, unfortunately, this becomes a ceiling. So when any lift up, if you're a true believer in being short this crypto after the wreck, I don't even know that you'd call this much of a wreck, but it certainly is a wreck from the high it was a year ago. You would really want this 19,000 area to hold. When any bursts up. All right. We'll wish everyone a great week of trading. As always, in every decision you make, even if it's buying a lollipop for your child, risk management. May the trades be with you, folks. Be well.